Hello, this is Kahlil Adam, head investor at Itaú Private Bank, and I would like to thank you for joining us once again for our monthly international markets update for August 2023. As market participants continue to look for signs as to whether the recent dip in economic activity in developed market economies will continue to a hard landing, or if growth will stabilize and reaccelerate, confirming a soft landing, they tuned into the annual Jackson Hole Symposium, which took place the week of August 21st. The Jackson Hole Symposium is an annual event where central bankers from around the world gather to discuss economic trends. Often, comments from this event give insight into the future economic and monetary policy trends. The consensus takeaway from this year's event was that there were few to no surprises. Both Fed Chairman Jerome Powell and his European counterpart, Christine Lagarde, emphasized data dependency. They discussed being prepared to raise rates further if necessary. However, in Powell's case, he stressed the need to proceed carefully, guided by economic data. The fixed income market took this as a sign that the Fed will remain on hold in the upcoming September meeting, and that as long as inflation remains in its current downtrend, we may have seen the peak for this rate hike cycle. And although equity markets were down for the month of August, breaking a 5-month winning streak, they recovered from their intra-month lows following the symposium. Turning to emerging market world, Chinese equity markets have significantly underperformed this year, with the MSCI China lagging the MSCI All-Country Index by 20% year-to-date. Pundits have pointed to lackluster post-COVID reopening, weakness in the real estate market, and frequent regulatory intervention as the main culprits. That said, Chinese officials have started to take measures to support both economic activity as well as their stock market. This past month, they continued their moderate easing cycle by reducing MLF loan rates for the second time this year, as well as cutting the stamp tax on equity trading to help boost activity. They also discussed limiting the number of IPOs, as well as taking measures to be perceived as more market-friendly to reinvite foreign capital. Equally as important is that they have allowed the yuan to weaken versus the dollar, which is down roughly 9% year-to-date and down to its last 12-month lows of 730. I highlight the fact that China is in stimulus mode for two reasons. One is historically, Chinese easing measures have been largely supportive to domestic equity prices, but also have positively impacted global emerging market equity prices. The second reason is, given China's relevance to global trade, a weaker yuan has had marginally deflationary impacts across the world. We will continue to monitor Chinese policy closely, given the impact it could have on the fight to contain global inflation while avoiding a hard landing. It's worth noting that our investment committee is currently overweight emerging market equities. Thank you for joining us, and we look forward to seeing you next month.